Welcome to our deep dive today. We're looking at a really significant moment coming up in the financial world. At the end of 2025, Warren Buffett steps down as CEO of Berkshire Hathaway.
Yeah, after 6 decades, 60 years, it's hard to even fathom. It really is the end of a major era.
Absolutely. So today, we wanted to kind of unpack that whole journey. How did the Oracle of Omaha become such a legend?
Exactly. We want to get into his investment philosophy, the core of it, and look at some key moments for Berkshire Hathaway, how it grew into this giant, and of course the lessons we can take away.
Because the scale of what he built is just immense. Our sources show how he turned this struggling textile company into, a $1.16 trillion conglomerate.
That's right. And the returns for shareholders, just off the charts. Really the stuff of financial history.
So let's start right back at the beginning. Omaha, Nebraska.
Yep, born August 30th, 1930 in Omaha. And apparently he had this entrepreneurial streak right from the get-go.
Like really early.
Oh, yeah. Selling chewing gum, magazines, door-to-door, had a paper route. Classic kid hustle stuff. But it shows that early interest in business, in making a dollar.
And it wasn't just about pocket money, it seems. He got into investing super young.
Unbelievably young.
Yeah.
Made his first stock purchase at 11, just 11 years old.
Wow. What was it?
3 shares of City Service Preferred. And then by 14, he'd bought some farmland and was renting it out.
14. That's incredible foresight for a teenager. Shows that long-term thinking already.
It really does. Understanding assets, income generation, it was clearly there from a very early age.
Okay, so he had this practical experience, but then his formal education really kicked in, especially under Benjamin Graham.
Right. Hugely influential. He actually got rejected by Harvard first, which is kind of funny in hindsight.
No way.
Yeah. But then he went to Columbia and studied under Graham, who was essentially the father of value investing.
And value investing is basically finding bargains in the stock market.
Pretty much. Graham's whole thing was buying stocks for significantly less than their intrinsic value, what the business is really worth, based on its assets and earning potential, not just the daily market price.
So digging into the numbers, finding those undervalued companies.
Exactly. Being analytical, rational. Buffett even worked for Graham's firm for a bit after graduating, really soaking up those principles.
But eventually, he went back to Omaha to do his own thing.
He did. Started his own investment partnership in 1956. And, he did incredibly well, became a millionaire pretty quickly, just applying those Graham principles.
And then came Charlie Munger. That meeting seems like a real turning point.
Oh, absolutely pivotal. Met him in 1959. Munger really helped evolve Buffett's thinking beyond just pure Graham-style value investing.
How so? What changed?
Well, they started moving away from just buying statistically cheap stocks, which often meant, okay-ish or even struggling companies. Graham called them cigar butts, one last puff left.
Right.
Munger pushed towards focusing on quality, buying truly great businesses, companies with durable competitive advantages, those famous moats, and run by really solid, trustworthy management.
So less about cheapness and more about long-term quality and strength.
Precisely. It's like deciding it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. That became a key mantra.
Which leads us right into Berkshire Hathaway. Because initially that was one of those struggling companies, wasn't it? A textile mill.
Exactly. He took control in 1965. On the surface, it looked like a classic Graham deep value play. The assets seemed cheap relative to the price, looking at the book value.
But the business itself
was doomed. Buffett realized pretty quickly that the textile industry in New England was on its way out. So instead of trying to fix the unfixable, he started using Berkshire's capital to buy other businesses.
So Berkshire became the vehicle for his investments.
Exactly, a holding company. And a really smart early move was getting into insurance.
National Indemnity in 67.
That's the one. Insurance companies collect premiums up front and pay claims later. That money they hold in the meantime, the float, is essentially cost-free capital they can invest.
Which gave Berkshire a huge pool of money to work with.
A massive advantage. That float really fueled Berkshire's ability to grow and acquire more businesses over the years.
And acquire they did across so many different sectors.
Oh, yeah. Insurance stayed core with Geico and General Re later on. But then utilities, railroads, industrial companies, retail, all sorts of consumer brands we know.
That See's Candy's acquisition in 72 seems like a great example of that shift towards quality over just cheapness.
Perfect example. He paid more than its book value, which probably would have made Graham scratch his head a bit.
Why do it then?
Because Buffett saw the brand. The customer loyalty, the pricing power that was the real value, the moat. That $25 million investment has churned out billions in profits since. It showed the power of a great business, even if it wasn't dirt cheap on paper.
And then you see these incredibly long holds, like Coca-Cola starting in 1988, held for, what, over 35 years now?
Embodies that long-term philosophy completely. Buy great companies and let them work for you.
He wasn't afraid of big bets either, especially in tough times, like the BNSF Railroad purchase in 2009.
Huge bet. $26 billion, his biggest deal ever, right in the aftermath of the financial crisis. He basically called it an all-in wager on the economic future of the United States.
Which looks pretty smart now.
Turned out very well, and more recently, the big move into Apple, which was surprising to some.
Because he'd mostly avoided tech, right? Outside his circle of competence, he'd say.
Exactly. For years, he admitted he just didn't understand tech businesses well enough. But with Apple, he saw the brand strength, the ecosystem, the customer loyalty things he does understand. It shows he can adapt.
So today, Berkshire is this, sprawling empire.
Yeah.
Owns almost 200 businesses outright.
Yeah, names everyone knows. Geico, BNSF, Dairy Queen, Duracell, Fruit of the Loom, See's Candies. The list goes on. Plus that massive stock portfolio, over $300 billion, dominated by Apple, Amex, Bank of America.
And the growth, it's staggering. If you put $1,000 in Berkshire back in the mid-'60s,
you'd be sitting on millions today. The Class A shares are up something like 5.5 million% since 1965. That's the power of compounding over decades.
Incredible. So let's dig into that philosophy a bit more. We've touched on value, quality, long-term. What are the absolute core tenets?
Okay, so at its heart, it is value investing, but evolved. It's buying high-quality companies at fair, not necessarily bargain basement prices, and then holding them, ideally forever.
With a big focus on those moats, the competitive advantages.
Huge focus. And equally important is the management. Are they capable? Are they honest? Buffett puts enormous weight on trustworthy leadership.
So it goes beyond just the numbers. It's about the business itself and the people running it.
Definitely. It's understanding the earning power, where the business is headed, and that long-term view is non-negotiable. You know that quote.
If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes.
That's the one. It completely rejects market timing or trying to guess short-term moves.
He's always said he has no idea what the market will do tomorrow.
Right. He focuses on the business fundamentals, ignores the noise, stays within his circle of competence, investing only in what he understands.
Which explains the long aversion to tech until Apple fit his criteria.
Exactly. And his approach to capital allocation is key too. Reinvesting profits back into the business rather than paying big dividends on the Class A shares has massively fueled growth through compounding.
And then there's Buffett the person, the folksy wisdom, the humility. That seems part of the package too.
Oh, absolutely. Living in the same house in Omaha he bought in '58, the approachable style, it resonates. And those annual meetings, the Woodstock for capitalists?
Legendary. Hours of Q&A, straight talk, humor.
He has this amazing knack for explaining complex ideas with simple analogies, making finance accessible. Mr. Market, the fat pitch. People remember those.
Okay, let's quickly run through some key milestones. It's been a long and eventful career.
For sure. Starting the partnership in '56, taking over Berkshire in '65, the crucial move into insurance soon after. Then in the '70s, buying into See's, the Washington Post.
The '80s brought Coca-Cola. '90s, the big Geico acquisition.
Yep. Navigating crises in the 2000s, like stepping up with Goldman Sachs in '08, plus the Giving Pledge philanthropy.
Then the 2010s with BNSF and Apple. And into the 2020s, seeing Berkshire cross $1 trillion in value. And sadly, the passing of Charlie Munger.
A truly remarkable timeline. Which brings us to now, this transition. End of 2025, Greg Abel takes over as CEO.
It really does feel like closing a major chapter. Abel's been groomed for this, right?
Yeah.
Vice chair, overseeing non-insurance stuff.
Yeah, he's been with Berkshire since the early 90s, deeply involved. He's the designated successor. It's the first CEO change since 1965.
And the reaction seems pretty positive overall. Leaders like Jamie Dimon, Tim Cook showing respect.
Very positive. There's huge respect for Buffett. And Buffett himself isn't vanishing. He'll stay on as chairman, keep his shares.
He seems very confident in Abel. Even said Abel might do better.
High praise. Abel sounds ready, humbled and honored. The general expectation is continuity, same philosophy, maybe slightly more active management, and Howard Buffett eventually becoming non-executive chair to help preserve the culture.
But the big question hanging out there is, the Buffett premium, right? Can Berkshire maintain that special value without him making the calls?
That's the multi-trillion-dollar question, isn't it? For so long, betting on Berkshire was betting on Buffett's genius. The market will have to figure out what it's worth without his direct hand on the tiller day to day. The assets are there, the philosophy is ingrained, but it's still a shift.
Even the annual meeting might change over time, you think?
Probably. It'll likely continue, but maybe not quite the same massive pilgrimage without Warren and Charlie front and center.
So reflecting on all this, what are the big, timeless lessons we pull from Buffett's career? Things that apply beyond just stocks.
Well, rule number 1 is classic. Never lose money. Rule number 2, never forget rule number 1.
Which is really about caution, doing your homework, avoiding big mistakes.
Exactly. Capital preservation first, then there's the contrarian idea. Be fearful when others are greedy, and greedy when others are fearful.
Don't follow the herd. Take advantage of market extremes.
Right. And think long term. Ignore the noise. Focus on the business, not the ticker symbol's daily blips.
He also stressed temperament over IQ, didn't he? Emotional discipline matters more than just being smart.
Crucial point. Staying rational when everyone else is panicking or euphoric. And sticking to what you know, that circle of competence. Don't venture into things you don't understand just because they're popular.
And finally, that emphasis on integrity and reputation.
Absolutely fundamental. Choose associates carefully. Act ethically yourself. Trust is invaluable in business and life. These aren't just investing rules, they're life principles.
So as Buffett prepares for this next phase, his legacy feels much bigger than just Berkshire or the money.
Definitely. It's about a common sense approach. Patience, ethics, wisdom. He's influenced millions with how he thinks about investing and living.
And for anyone listening, the takeaways seem pretty clear. Think long-term, value integrity, and always keep investing in yourself, in your own understanding.
That's maybe the ultimate Buffett lesson. Invest in yourself. So as this era shifts at Berkshire, maybe it's a good prompt for all of us to think about our own circle of competence, our own long-term goals, and, what kind of investor, what kind of person do you want to be?